Picture this. I'm scrolling through financial Twitter last month when I see yet another analyst celebrating BlackRock's Bitcoin ETF hitting new records. The comments are flooded with institutional adoption finally and Bitcoin to the moon. And I'm sitting there thinking, you guys, you're celebrating the warm-up act while the main event is happening backstage. What if I told you that while everyone's fixated on BlackRock's $15 billion Bitcoin ETF success, Larry Fink and his team have been methodically orchestrating an $18.9 trillion infrastructure transformation that will make Bitcoin look like a rounding error? We're talking about the complete digitization of global finance, and the networks powering this revolution aren't the ones you'd expect. Here's the bombshell that'll change how you view everything. According to comprehensive research from Boston Consulting Group and Ripple, the tokenized real-world asset market isn't just growing. It's exploding at a mind-bending 380% to reach $24 billion in 2025, with projections showing it could hit $18.9 trillion by 2033. That's not a typo. We're witnessing the foundation of one of the largest capital shifts in financial history, and most people are completely missing it. The great misdirection. Bitcoin ETFs as strategic theater. Let me break down something that'll absolutely shock you about BlackRock's Bitcoin strategy. This is the most sophisticated misdirection play I've ever witnessed in institutional finance. Think about this logically. Bitcoin processes a measly 3 to 7 transactions per second with 10-minute block confirmations. That's an hour before your transaction achieves finality. Compare that to Visa's 1,700 transactions per second, and you quickly realize Bitcoin's architecture is fundamentally incompatible with institutional scale financial flows. But here's where it gets fascinating. Treasury Department sources confirm that BlackRock's internal pilots have already demonstrated settlement finality in under 2 seconds using purpose-built blockchain networks. While retail investors debate Bitcoin's price movements, BlackRock has been systematically evaluating which settlement infrastructures can handle institutional capital deployment strategies worth trillions. The numbers tell an incredible story. The tokenized asset market has surged an extraordinary 380% to reach $24 billion in 2025, establishing it as crypto's second fastest growing sector after stablecoins. But here's what most people completely miss. Private credit now dominates this landscape at $14.7 billion, led by Figure Protocol's massive $10.6 billion allocation. We're talking about 8 to 12% yield compared to traditional markets' pathetic 0. 5 to 2% returns, the $2.89 billion proof of concept. BlackRock's USD Institutional Digital Liquidity Fund, known as BUIDL, tells the real story of what's happening. Launched in March 2024, this tokenized money market fund has grown to $2.89 billion in assets under management, making it the world's largest tokenized treasury fund. But the growth trajectory is what should make you pay attention. BUIDL captured $1 billion between March and June 2025 alone, representing half of the entire $2 billion expansion in the tokenized treasury market during that period. The fund now commands 41.1% of the entire $7.34 billion tokenized money market sector. This wasn't speculative retail money chasing hype. This was institutional demand for 24/7 liquidity access, same-day settlement, and direct collateral eligibility. Here's what makes this remarkable from a technical perspective. BUIDL operates across 7 blockchain networks, including Ethereum, Solana, Aptos, Arbitrum, Avalanche, Optimism, and Polygon, with over 90% of assets concentrated on Ethereum. The fund maintains a stable $1.00 value while generating approximately 4.5% annual yield through daily dividend accruals distributed directly to investor wallets. Bank of New York Mellon serves as custodian for traditional securities, while digital custody is provided by institutional-grade firms including Anchorage, Digital, BitGo, Copper, and Fireblocks. But here's the institutional validation that should make you sit up and take notice. BUIDL has achieved significant integration with DeFi protocols, serving as collateral on major exchanges and backing Ethna's USDTB stablecoin with over $320 million in BUIDL tokens. The private credit revolution, nobody's talking about. Now here's where the data gets absolutely mind-blowing. Private credit has emerged as the unexpected leader in tokenized assets. reaching $14 billion in value and representing approximately 61% of the total tokenization market. Let me explain why this matters more than any Bitcoin price movement you've ever tracked. Traditional private credit markets have historically demanded minimum investments of $5 to $10 million with multi-year lockup periods. Institutional investors accept these constraints because private credit typically delivers yields ranging from 8 to 12%, significantly higher than public credit markets. But tokenization is completely transforming this dynamic. Platforms like Figure have facilitated nearly $4 billion in tokenized private credit in 2024 alone, while protocols including Centrifuge, Maple, and Tradable have expanded the ecosystem to include institutional private loans, structured credit products, consumer mortgages, and real estate-backed debt. The on-chain securitization process reduces operational costs by up to 97% while providing transparent, real-time loan performance tracking that was previously unavailable. Here's a kicker that should make traditional finance executives lose sleep. Comprehensive research involving 26 global asset managers revealed that tokenization could unlock over $135 billion in cost savings industry-wide, representing a 23% reduction in operational costs. By 2028, distributed ledger technology-based capital market infrastructure could reduce middle and back office expenses by up to 85%. The hidden rails of tomorrow's financial system. While everyone debates Bitcoin's next price target, the real infrastructure revolution is happening on networks that most crypto investors completely ignore. I'm talking about Ripple's XRP ledger and Stellar's protocol enterprise-grade settlement networks that have spent over a decade building exactly the capabilities institutional finance demands. Let me hit you with some data that illustrates the scale of what's already operational. Ripple's network connects over 300 financial institutions across 4 zero-plus countries, including major partnerships with Santander, Bank of America, Standard Chartered, American Express, and PNC Bank. The company's on-demand liquidity service has demonstrated cost reductions of up to 70% in cross-border payment corridors, with settlement times under 30 seconds compared to days through traditional correspondent banking. But here's where it gets absolutely wild from an institutional adoption perspective. Ripple has secured partnerships with 10 governments for central bank digital currency development, including collaborations with Bhutan, Palau, Montenegro, Georgia, and Colombia. The European Central Bank selected Ripple's XRP ledger for its digital euro pilot program starting June 2025, engaging over 500 financial entities in regulated digital bond issuance trials. Think about what that means. The ECB, one of the most conservative financial institutions on Earth, chose Ripple's infrastructure for testing the future of European monetary systems. That's not speculation, that's institutional validation at the highest levels of global finance. Meanwhile, Stellar's institutional adoption accelerated dramatically throughout 2025, with its native token XLM surging over 319% year-to-date, driven by strategic integrations with PayPal and MoneyGram. PayPal's integration of its PYUSD stablecoin onto Stellar's network represents a significant validation of Stellar's payment infrastructure, extending PYUSD's reach to over 180 countries, while enabling real-time merchant payments. MoneyGram's 3-year partnership with Stellar demonstrates real-world utility at massive scale. Since launching crypto-to-cash services in 2022, MoneyGram Ramps has facilitated nearly $30 million in total transaction volume across over 170 countries. The service enables stablecoin to cash conversions at thousands of MoneyGram locations worldwide. Humanitarian organizations including UN, HCR, and IRC have delivered USDC directly to recipients' wallets for on-demand cash access, bypassing traditional banking infrastructure entirely. And you guys, I have a special trick for you which nobody seems to be using, and I cannot wrap my head around why. Because if you sign up through my link down in the description onto the BUIDL exchange, you get a 10% deposit bonus. And now stay with me here. Now here comes the important part. If you have any trading capital on any other exchange and you move it to your newly created BUIDL account, you get on top of your capital. You moved another 10% extra trading capital. As an example, if you move or deposit $10,000 to your account, you get a $1,000 for free. And here is why this is possible. BUIDL makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, BUIDL's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video. Alright, let's jump back into the video. The cross-border payment revolution. Here's where the scale of this transformation becomes absolutely staggering. The global cross-border payments market was valued at $194 trillion in 2024 and is projected to reach $290 trillion by 2030. Yet traditional systems remain hampered by 3 to 5 day settlement times, fees ranging from $25 to $50 per transfer, and opaque intermediary costs that can add up to 7% for remittances to Africa. SWIFT data reveals that correspondent banking relationships declined consistently from 2011 through 2017, with all regions except North America experiencing reductions in active correspondence ranging from 15.5% to 27.6%. Despite fewer correspondents, payment message volumes increased, suggesting longer payment chains that add time and cost to every transaction. Blockchain-based tokenized payments completely eliminate these inefficiencies. Ripple's on-demand liquidity addresses these problems by using XRP as a bridge currency for real-time cross-border payments. XRP transactions cost approximately $0.0004 compared to $1.88 for Bitcoin, making it exponentially more cost-effective for institutional settlement. The service enables institutions to convert source currency to XRP in real time, transfer XRP across the ledger, and convert to target currency at the destination, typically completing the entire process in under 4 minutes. Real-world adoption spans 6 continents, with ODL live in numerous corridors focusing on high-friction payment routes between the US, Mexico, Eurozone, Asia, and Middle East India. The CBDC integration layer. Here's something that might surprise you about the regulatory landscape driving this transformation. As of 2025, 105 countries representing over 95% of global GDP are actively exploring central bank digital currencies, with 60% of central banks accelerating their initiatives compared to previous years. China's digital yuan has processed over $14 billion in transactions, while India's e-rupee pilot expanded to over 1 million users. Nigeria's e-naira recorded 10 million active users, doubling from 5 million in 2023. These aren't experiments anymore, they are production systems demonstrating institutional confidence in blockchain monetary infrastructure. But here's the geopolitical twist that changes everything. The Trump administration's executive order in January 2025 explicitly prohibiting U.S. CBDC development has accelerated adoption elsewhere, with countries viewing this as an opportunity to establish leadership in digital currency innovation. Europe's digital euro preparation phase plans to finalize scheme rulebooks by October 2025, while Brazil hopes to launch its blockchain-based Drex currency for general use. The Bank for International Settlements envisions unified ledgers combining tokenized central bank reserves, commercial bank money, and government bonds to harness tokenization's full benefits. This architecture promises to replace complex correspondent banking chains with integrated processes, reducing operational risks while enabling automated collateral management and delivery versus payment arrangements. The programmable finance revolution. Now here's where things get truly revolutionary from a technological standpoint. Programmable money represents a fundamental evolution beyond traditional currency, enabling digital assets to execute complex financial operations automatically through embedded smart contract logic. Major institutions including Citi Treasury and JP Morgan have launched programmable money solutions that provide always-on financial services, automated escrow management, and real-time compliance monitoring. Smart contracts eliminate manual reconciliation, reduce operational costs by up to 97%, and provide transparent transaction execution with built-in audit trails. The automation capabilities are transforming every aspect of finance. Insurance applications now automatically trigger payouts based on verifiable data feeds, eliminating claims, processing delays. Real-world assets are increasingly integrated into decentralized finance lending pools, serving as collateral for institutional loans and unlocking liquidity from previously illiquid investments. Total value locked in DeFi protocols now exceeds $250 billion as of 2025, representing growth from $53.63 billion in April 2023. These self-executing agreements enable intermediary-free transactions across lending, borrowing, trading, yield farming, and asset tokenization, increasing profitability by 8 to 20% compared to traditional financial processes. The real estate and equity tokenization wave. Real estate tokenization specifically is projected to experience extraordinary growth, with the global market expanding at a 21% compound annual growth rate through 2033. Market projections indicate tokenized real estate could reach $19.4 billion by 2033, up from $3.5 billion in 2024, while Deloitte forecasts $4 trillion of real estate will be tokenized by 2035, representing 15% of real estate assets under management. This fractional ownership model enables investors to own portions of high-value property starting at $1,000 increments, rather than requiring millions in traditional real estate investment. Real estate tokenization could unlock $63 trillion in digital assets if just 10% of the $630 trillion global real estate market becomes tokenized. The tokenized equity sector shows promising developments despite regulatory constraints. Regulated asset-backed solutions like backed finance and on-chain's institutional-grade infrastructure offer compliant on-chain equity issuance with built-in corporate actions and transparent proof of reserves. Conservative projections estimate tokenized equity markets reaching $100 million to $1 billion by end 2025, driven by regulatory clarity and institutional adoption. The institutional convergence. What we're witnessing represents nothing less than a systematic campaign to re-engineer global capital markets for the digital era. The institutional adoption wave reflects years of infrastructure development, culminating in production-scale deployment. Asset tokenization has decisively transitioned from experimental pilots to scaled institutional adoption, with governments increasingly recognizing blockchain as essential infrastructure for modernizing legacy financial systems. Major financial institutions, including BlackRock, JP Morgan, Franklin Templeton, and Apollo, have moved beyond experimentation to production-scale deployment. Goldman Sachs and BNY Mellon are tokenizing money market funds alongside partners like Fidelity, targeting efficiency improvements and settlement time reductions. European institutional investors began allocating to tokenized funds, as evidenced by major public investment banks, allocating to blockchain-settled products. DeFi integration through regulated frameworks is unlocking the next growth phase, transforming historically illiquid assets into composable financial primitives. The $18.9 trillion trajectory. Looking ahead, market projections vary but consistently point to massive expansion. McKinsey predicts a $2 to $4 trillion market by 2030, while Standard Chartered forecasts $30 trillion by 2034. The most comprehensive projection from Ripple and Boston Consulting Group anticipates $18.9 trillion by 2033. Conservative scenarios still project $12 trillion, while optimistic forecasts reach $23.4 trillion, indicating tokenization's potential to become one of the most significant infrastructure transformations in financial history. The current $24 billion tokenization market represents not the culmination but the early foundation of a multi-trillion-dollar transformation. The quiet revolution's endgame. Here's what most people don't understand about this transformation. We're not witnessing gradual evolution, but systematic revolution. The tokenization of real-world assets promises to reshape global financial markets through enhanced liquidity, transparency, and accessibility on a scale that dwarfs previous technological disruptions. As central banks finalize CBDC frameworks, financial institutions integrate blockchain settlement infrastructure, and asset managers scale tokenized product offerings, the convergence toward a programmable, globally interoperable financial system appears not just inevitable, but actively under construction. The institutions positioning themselves at the intersection of traditional finance and blockchain infrastructure stand to capture disproportionate value as this transformation unfolds. BlackRock with its asset management dominance, Ripple and Stellar with their regulatory compliant settlement networks, and major banks with evolving digital asset strategies are building the architecture that will power global finance for generations. By the time mainstream recognition arrives, the infrastructure will be operational, partnerships established, and control points secured. The networks winning this transition won't just participate in the new system, they'll own it, capturing perpetual value flows as digital representations of every asset class move through their rails. This represents the first chapter in complete digitization of global finance, where programmable money, automated settlements, fractional ownership, and 24/7's global liquidity become the operational standard rather than experimental innovation. The question isn't whether this transformation will occur, it's whether you'll recognize the infrastructure before it becomes indispensable to every financial transaction on Earth. The architects of tomorrow's financial system are already building today, and their success will reshape how value moves, settles, and generates returns across every market on the planet. The era of manual reconciliation, delayed settlements, and opaque custody will give way to an automated, transparent, and programmable financial infrastructure controlled by the few institutions that built and governed the rails. If this deep dive into the hidden financial revolution resonates with you, smash that like button, subscribe for more institutional crypto analysis, and drop a comment sharing your thoughts on tokenization's impact. Most importantly, share this with anyone still thinking Bitcoin ETFs represent crypto's institutional endgame, because while they're watching price tickers, the real revolution is happening in the infrastructure that will power every financial transaction for decades to come.